Good morning, everyone. My name is Shelley Tannenbaum. I'm a member of the Quaker Institute for the Future Board, and I'm going to be clerking these two morning sessions today. Morning for me, midday for someone. I want to go over the general format for what we do in these morning sessions. Somebody will be presenting a piece of their research or a project that they're working on, or something that they're, maybe a book that they're considering writing, or some thoughts they have. And they'll spend somewhere between 20 minutes, half hour to an hour doing that presentation. About how much time do you think you'll want, John, for this morning?
I think about 40 minutes.
Okay, and do you want me to give you a warning when we get close to that?
Sure.
Okay. And then we'll, and if you have, is it okay with you if people have clarifying questions to ask them, or would you like them to hold all their questions till later?
Clarifying questions are fine.
Okay. But what I'd like to do is ask you to hold more either comments or questions that you have that might be more programmatic or go into more detail until John's finished his presentation. And then we will go into worship together to see what bubbles up, remembering what came up for you as you were listening to him, but also what comes up to you out of the silence. We'll see how many people we end up with at that point. I'd like to try it without raising hands, but to speak out of the silence to present what either comments you want to make or any questions you have for John. If it gets a little too busy, I will ask people to raise their hand and I'll call on them. It's helpful to leave some space between each person who has either presented comments or asked questions to just settle back in so that you could focus on their questions and John's responses as they happen. And that's the general format. We'll be taking a break a little before 10:30, hopefully 10:25. We'll see if we make it. We'll be taking a short 10-minute break, and then we'll go into our second presentation of the morning. So that's the general format. Does anyone have any questions about that? So I'm going to turn it over to you, John. Please go ahead.
Okay, I'm going to share the screen, but I think we'll take a few minutes of silence first in preparation. Well, thank you, friends, for being together for this. Let me say a few things sort of personal here to begin with in terms of how I got into this and the support system for which I'm grateful. I'll indicate to you that I've asked my wife, Suzanne, to be on board here. So, and her image there is listed with my name on it. So my name's listed twice, but I asked her specifically to be here because she's been so important to me in the development of my ideas and my work in this area. And she is also a member of the committee of the League of Women Voters of their monetary program committee, and I'll be talking a little bit about that later. I also want to acknowledge how I got into this whole business to begin with. I'm a physiologist, and I retired 10 years ago, and was on the board of a local peace and justice organization called the Appalachian Peace and Justice Network. And I was invited Greg Coleridge from the AFSC office up in Northeastern Ohio to come down and talk at one of our annual meetings. After I had a chance to talk to Greg, and we were talking about a number of things about our concerns, and he raised the whole issue of the monetary system, and was indicating to me that, banks create money. And I said, what? Wait a minute, isn't that counterfeiting? I thought the government created money. Anyway, this conversation essentially generated a lot of thinking in my mind over the last 11 years, really. And he's very much, I'm grateful to him for bringing my attention to it. And also my thinking has been helped along the way by interactions with Ed Drevey and John Lodenkamper as well. So let me go on to offer an outline here. This is what I'm going to talk about. I'm going to talk about the monetary system in relation to Green New Deal and degrowth. That perhaps is the major item. But then I'm going to tell you a little bit about a project that I have going with the League of Women Voters, which has the potential to be very interesting. And just a few words on the update on the Alliance for Just Money, and I'm on the board of that organization. So a few days ago, well, maybe more than, a few days ago, I was still kind of wallowing around and trying to figure out what I was really going to say with this opportunity to talk to you folks today. And then I read through, looked through that enormous piece of document that Jeff sent out. And down at the end of it was this paper called A Green New Deal Without Growth. And I read that paper, and that's what told me what I was to talk about today. So what that paper says in summary is that, as quoted here, a Green New Deal should not depend on GDP growth for its financing. Well, right away, you know that everybody else is thinking about addressing the Green New Deal with a big increase in gross national product, big increase in federal spending, and so on. So here's a statement that a Green New Deal should not depend on GDP growth for its financing, but rather should mobilize financial resources through, and they list three ways. And the first one is familiar to all of us, one Quakers have been lobbying for forever, the reallocation of public expenditures from armaments and fossil fuel subsidies to green physical and social infrastructure. So that's familiar and well recognized. The second one is also well recognized and familiar to us, the increase of marginal taxation on the top income brackets. That's tax the rich. And that's certainly in discussion now in politics and in many areas, even supported by some of the very wealthy people. The third one is the one that's interesting. The third one is the public issuance of sovereign money. That's not one that we're so familiar with, and not one that many people are talking about. Yet the authors of this paper regard that as equally essential to developing a Green New Deal to address the climate issues and the ecological issues without increasing GDP, without increasing the throughput, in Herman Daly's terms, of resources that, and those the throughput of resources, of course, is consuming of resources and the production of waste products. And GDP doesn't measure those things well at all. But nonetheless, when GDP goes up, the throughput tends to go up too. So increasing the GDP is simply seen as incompatible with a Green New Deal that is in fact sustainable, that is independent of growth. So then why is the public issuance of sovereign money essential for a Green New Deal without growth? So that's the question that I'd like to address. I showed this slide last year, and I'll show you a couple other slides that I showed last year, but I just want to remind people about this, that historically there have been two main ways of creation of money systems in societies. One is money created by government over here on the left, and the other on the right is money created as credit by banks. Now, what we have today is something of a mixed system, although it's dominantly money created by banks. Our government does, in fact, create money. It creates money as coins, but that's all. And it doesn't even create money as bills. That's done by the Federal Reserve, not by the government itself. And the Federal Reserve is separate from the government. So we have our system dominantly is one in which money is created as credit by banks. And, you know, one of the interesting ironies about this is that if you look over here on the right side, with money created as credit by banks, the money, the banks loan the money into the into the economy where it circulates around and does all the things that a medium of exchange is supposed to do. But the banks expect to get it all back, plus a little more. So you look at that and you say, wow, this system requires that the agencies that are providing our money supply are taking more out than they're putting in. How can that even work? And of course, it works simply because the rate of money lending exceeds the rate at which is payback of the loans, principal plus the interest. So, and it can be argued that, well, these are not the only two monetary options. And we're seeing this today because we're seeing now private organizations that are not banks putting forth currencies, digital currencies, and offering these as substitutes for the currencies that we're using at the present time. And we're not going to talk about those very much. We can talk about those later on in discussion, perhaps, if people are interested. But I want to essentially contrast these two that are on the slide before you. So as all of you know, I'm sure that the bills and coins constitute a small fraction of our money supply. 95% of it, roughly, is account money only, which exists only as numbers in computers. It has no existence as anything physically, coins, bills, or anything else. It's simply account money kept track of in accounts. Well, so let's come back to this question. And in order to address this question, I'm going to take you through a thought experiment that addresses a slightly different question, but then I'll come back to show you why the two are linked. So the simple thought experiment is, let's pretend that we're going to set up an economy from scratch. And for some reason, we're going to do it like we've been thinking about, like our current economy works. So we're going to depend on a loan from a bank to get that economy going, instead of creating it ourselves, which we could do. But this is a thought experiment about what the consequences are of a debt money system, of the bank creation money system. So anyway, let's say we have to start here with 100 units, whatever they are, $100, $100 billion, whatever. And we are going to take out a loan of that amount to essentially power our economy. So we take out that loan and it gets distributed somehow amongst the people in the economy, and farmers can produce their stuff and tradespeople can buy the food and sell their products of their trades and so on, and the economy goes forward. And at the end of the year, since that was a 1-year loan, we got to pay it back. So what we have to pay back, of course, is $100 principal plus $10 interest. But the $10 interest isn't around because it hasn't been created. So what do we have to do? Well, what we have to do is, in effect, roll over this loan, which means in order to keep $100 in the economy, we have to take out a new $100 loan, well, we're to essentially pay off the old $100 loan. And in order to take that loan out, we also have to take the loan out for more than $100, namely the amount of interest we pay. So we have to take out a loan of $110 for the second year. End of the second year, we now again have to take out a loan of another $100, but we have to take out a loan that's equal to what we have borrowed last time, which is 110, plus the interest due during this period. So now we have to take out a loan of $121, simply to sustain the amount of money in the economy. This analysis, of course, makes a number of assumptions about the stability of the economy. It's not growing, the population stays the same, other factors stay the same. And also, you could argue that this is an exaggeration because, after all, the banker himself is not totally separated from the economy. He has to go to the grocery store too and pay his tellers and this kind of thing. So this is undoubtedly something of an exaggeration. It would be lower than this, okay? And we've got loan at 10% interest, and I've done that simply for the ease of calculation. And that if it were the interest were lower, this line also would be somewhat depressed. And what you can maybe see there, but it's not terribly clear, is that this is an exponentially rising curve. And as a matter of fact, if we calculate this out for 20 years, let me see if I can do this here. If we calculate this out for 20 years, we see this exponentially rising curve in this way. That's very clear. And this curve pretty much matches we're talking about, let me go back here. So what we said is that the loans have to go up in this way. And the result of that is that the total money supply, that is to say the money supply here and the money supply that has been somehow sequestered in the financial sector, saved, hoarded, whatever you want to call it, the total money supply is going up all this time, while more and more of it is being sequestered away in the financial sector by the banks, okay? And this curve, this exponential curve, approximates very well the money supply. This is data from the UK, for instance, between 1960 and 2010, and you can see this exponential rise is occurring here. We won't deal with these little glitches that have occurred just recently right now, but you can see the overall pattern is certainly one of exponential rise. Okay, now we've talked about that means there's going to be this increase in money supply going on as a result of this bank money system. But what's that got to do with then the business of productivity and production and throughput and so on? Well, in order to link those two things, I think you really have to look at this equation, which is a standard equation in economics. Namely, that the money supply in dollars multiplied by the velocity of money flowing through the system, that is to say, a given dollar may be used in a year just in one transaction, or it may be used in a whole series of transactions, showing a higher velocity. So this is essentially the total MV then, is the total amount of money spent during that period, for instance, a year. And it's equal then to two things: the product of prices and the quantity of goods and services that are produced, as measured in dollars per year. So the P and the Q particularly is the production of goods and services. So that's related to GDP. Okay, production of goods and services. You multiply that by the price and you've got the amount of money that turns over. So the equation is balanced. It's the amount of money that turns over in the system, just viewed from two different points of view. So what happens then when the money supply goes up in a system like?
Quick question of clarification. So PQ is roughly the same as GDP, or is it GDP?
I think to a first approximation, you can say that that's GDP.
Okay.
Okay. So what would happen when the money supply goes up, since we've seen that that's what has to happen, what does happen in a system that's run essentially, that's powered by bank creation of money as debt? Well, with you increase the money supply, either of these two could in principle go up or this could go down. So we have several things could happen here. In the scenario that I've given you, there's no compelling reason to think that the velocity is going to change. With more money in the system, we're all aware of the fact that prices can go up because that's what happens. That's what our concern about inflation. Prices go up because more money in the system. But again, in our scenario, it's not clear why people would necessarily increase the prices a lot. So it's not a major variable. But what might happen is, what is most likely to happen is, with more money in the system, there's more money available for people to invest in new ventures. It's the way that we think of stimulating an economy, by having more money available, easily available for people to borrow, to invest in a new enterprise, to increase the GDP and increase the production. So this is likely to go up as a result of the increased money supply. And of course, this going up, in fact, is going to mean an increase in output. That's what it says. It is an increase in output that increases the GDP, and that's what increases the throughput of resources to waste. So this is the way the linkage occur between the money supply, the availability of it, and then the production that results in the threat to our ecological balance. So Mastini's formula then for a no-growth GDP we've already seen, so that the sovereign money system is required for a no-growth economy, with or without a Green New Deal, as a matter of fact. The Green New Deal just makes it a bigger challenge. Okay. Let me talk about then the alternatives. So we talked about the fact there are these two ways of creating money, either by government or by private banks. And private banks are what create our money now, but there have been proposals to change that. And the proposals have actually go way back in history, as a matter of fact, because in fact, our government created money, well, during the Revolutionary War, during Madison's administration, after the end of the first U.S. National Bank, the government issued bills of credit, which was in effect issuing fiat money. Then after the collapse of the second U.S. National Bank it collapsed under Jackson's administration, and then his successor, I have trouble with names these days, but his successor then initially was a gold bug, but then realized he was making a dreadful mistake because there was a big depression, and he started essentially the government creating money. So there's a long history of government creation of money, both in the United States and earlier in history throughout the world. So the idea of government creation of money really enjoyed a rebirth in the Depression, because we had this enormous problem. The banking system had totally collapsed by 1933, and we were in a serious depression with serious unemployment and hunger and all the rest that you already know about. Well, what the Chicago plan was, it came out of really 6 economists. I think most of them were at the University of Chicago, and thus the name. And one of them, of course, was a Quaker, and that was Paul Douglas. And what this plan basically said is that, the problem we've had is that with our money in the banks, our deposits in the banks, that's money that we use to pay our bills. That's the money in our checking accounts that makes the economy work. And we need to protect those deposits from this kind of thing that we've just witnessed, namely that lending occurring against those deposits, then when people want their money, it's not there. So what they suggested was a program of 100% reserves. And incidentally, the full program came out, the first one was just a fairly short, I think, I don't know, it was just a few pages. But in 1939, then Paul Douglas authored a larger version of it, again with several co-authors, called a program for monetary reform. That was that document is available, but it never got published. It never even got published in a journal. Never mind, it never got translated into any law. So you can go to the web and you can find a copy of the typed version of this with Paul Douglas's notes on it, as a matter of fact. And that's the access we have to it. But what it did is said, look, all demand deposits are going to stay in the bank, either as cash in a bank's vault or as reserves in the Federal Reserve banks. So that way, no matter who goes to the bank, when, or how many people go to the bank to get their money, they'll get it. And that will mean the end of bank panics, the end of this fear that, oh, my money's going to disappear. It also would have the effect of better control of credit cycles, because this threat of the economy going downhill is eliminated because you can always get your money. And also what this would mean during a positive phase of economic growth was that economic growth would not be driven by banks creating new money. Instead, all the new money would be created by government, presumably in the public interest. So what it would also mean was government would issue money at 0 interest to regulate the money supply. And this would mean reduction of government debt, because there would not have to be any more government borrowing. And there will also be reduction of private debt, because with the present system, essentially, all the money in circulation has been loaned into circulation by banks. So that means we are paying interest to the banks on every dollar in circulation. Well, you take that burden off the economy, and you can see your way to thinking about the reduction of private debt, which was predicted. So in this system, banks can still lend, but they're going to have to lend pre-existing money that's deposited with them for the specific intent that the money is to be loaned out. This is what we call investment banking. You give some money, you loan your money to an investment banker, and he's going to invest it somewhere. Now, you can't necessarily get that back in an instant. It's not a demand deposit. It's a different kind of investment. So banks can still lend with this system. So that was the proposal that came out of the Depression, and nothing much happened because the world's attention was swallowed up by World War II. So these ideas then languished. And after World War II, of course, there was unique situations in the United States where the United States was driving the world's economy and saw this enormous economic growth that, in fact, was funded by bank lending. It's interesting that the national debt that was encountered was developed during World War II, which was a big spike in the federal debt. That debt, in fact, was never paid off. If you see plots of the federal debt as a function, the federal debt as a ratio of GDP, it looks like that World War debt was paid off because but what happened was just this enormous surge of gross domestic product after World War II simply swamped out that debt, so it became almost imperceptible. So now in 2011 and 2012, Dennis Kucinich introduced a bill, the National Emergency Employment Defense Act, which was based on the Chicago Plan, slightly different, but based on it, okay? And that effort, Dennis Kucinich didn't come up with this all on his own. It largely came out of the efforts of a man named Stephen Zarlenga, who was formed the American Monetary Institute. And he'd been working for this a long time and you know, picked up on these ideas from the Depression and realized how important they were. He published a big book called The Lost Science of Money. It's an 800-pager. It's very well referenced. And anyway, it turns out the story was that Elizabeth Kucinich, her name wasn't Kucinich at the time, came over from England to work with Stephen Zarlenga because she had somehow got involved in this kind of thinking as well. And the two of them went to see Dennis Kucinich and to get him to introduce this bill, and he did. But another outcome of the meeting was that Dennis and Elizabeth got married. So it was an interesting outcome. But in any case, what this NEED Act, N-E-E-D, so you can see it's referred to as the NEED Act, the National Emergency Employment Defense Act. So it ended the creation of money by banks. It said no more fractional reserve lending, and it set up a system of money creation within the government with oversight by an independent monetary authority. This idea of a monetary authority had already been proposed by Paul Douglas and Irving Fisher and the others back in the 30s. And the third thing that the NEED Act would do it was to end the Federal Reserve as a separate agency by bringing its essential functions into the Treasury Department. Well, the question is, well, what would a sovereign money system do? And we can list a number of things and then take our time and talk about each one of these independently. It would enable the government to spend on GDP, on a Green New Deal, without incurring new federal debt. It will enable the government to spend whatever it wants to without incurring federal debt, because instead of borrowing, it can create the money to do so. It would enable the government to direct new money to address social and physical needs of the country. You know, bank lending, the creation of money through lending concentrates wealth because banks lend to people who already have money, people who have collateral, people who are good risks. The government, at its best, spends in ways to distribute wealth. Distributes it in terms of social security systems, in terms of education, in terms of infrastructure, healthcare, and all these things that benefit everybody. And this is a way of distributing wealth. So lending, creation of money by lending by banks concentrates wealth. Creation of money by spending by government would tend to distribute wealth. It would allow the government to control, to limit the money supply by ending bank creation of money. Right now, the rate of money creation is just as fast as the banks can make loans. And they got advertisements all over. They're eager to make loans. They're eager to increase the money supply, okay, because that's the way they make profit. So there's no way at the present time that for any agency to really limit the money supply. The Federal Reserve has some influence over it, but it's very indirect and very weak. So another thing is, that this process of sovereign money would restrain bank lending. And what happens in our current system is that the banks lend to a lot of these organizations, these agencies, entities that are referred to as shadow banks. These shadow banks, these organizations in the shadow banking sector are all agencies which are restricted. Well, they're not restricted, but all they do is to borrow and lend. So a shadow bank like a private equity firm or a hedge fund, what does it do? It gets money from people who want to invest because they think this is going to earn them some money. And so there's some capital, some equity invested in these companies, but people, and that's a form of lending, even though we call it investing, because the investors expect to get it back. So the hedge fund then uses that as collateral to borrow money, typically from a bank. It uses with that equity as collateral, and now they can lend to somebody else who will pay higher interest. So that's what happens, and under sovereign money, the banks themselves won't be able to create money willy-nilly as they wish to. They are going to be somewhat restrained by the resources they have, namely the pre-existing money that has been deposited with them for that purpose. And the other aspect of it is, and although this is not written in specifically to either the 1939 law or the Need Act, but it's certainly understood and would have to be imposed, and that is that banks would have to take full risk for their lending, and this business of bailing out banks would have to end. And that way, banks would alter their behavior in a way that would limit this unrestrained expansions that occur in boom times. So sovereign money then would also, through the government, provide needed social services. It would also end lending at high interest rates, at least the Need Act would, because it sets a cap of interest at 8%. 8% is still pretty high. But as you well know, there's a lot of lending that occurs at interest rates way beyond that. And finally, while raising living standards for the poor by government spending on these things that benefit us all, it would decrease wealth concentration and therefore consumption by the wealthy, because it would decrease this concentration of wealth that occurs through bank creation of money. So that's the point here, that a no growth or deep growth economy requires a transition to sovereign money. Now, that's the end of that portion of my talk. I might just pause here to see if there are any questions for clarification that would arise here before I tell you about the monetary project that I'm doing with the League of Women Voters.
And just a time check for you, John. It's been almost 40 minutes.
Is it? Okay. Let me go on then and briefly describe this project with the League of Women Voters. Some time ago, I was asked to be on the board of the League of Women Voters, and I realized that, wow, this is possibly an opportunity to get the League of Women Voters involved in this kind of an issue. So I read carefully the document that the League has, and they have a document much like the FCNL's document, the Word We Seek. And out of that, I extracted these 5 issues that are related to the monetary issues on which, but these are issues that the League has spoken to. And one, of course, is their commitment to democracy, and therefore it's in a sense a commitment to be concerned about the distribution of wealth and power. And 2 other things here on the right, they're obviously concerned about poverty and meeting human needs. They're concerned about climate change and environment. These are all built into lobbying issues that the League is involved with at the present time. They have a couple of other interesting testimonies, if I can use a Quaker term here, They're concerned about the privatization of government programs and whether they're transparent or not. And of course, our money system has been privatized. It was privatized, it was outsourced by the Federal Reserve System, formally outsourced. And then there's another issue that the League is interested in. It just talks about their concern about deficit policies. And so they want responsible deficit policies. So all of these are then sort of handles to get the League to consider this issue. And I keep coming back to this quote from Justice Brandeis: either we can have democracy in this country or we can have great wealth concentrated in the hands of a few, but we cannot have both. So that's why I say the League's concern for democracy has to be concerned with this issue of wealth distribution. So anyway, what I proposed, what we did was let me just go back to this other slide for a minute. I proposed this to the local league. We had a local meeting here, and some of the people were enthusiastic about carrying this further. We took it to the state league, the state convention of the state of Ohio, presented a caucus there, invited people from around the state to join us in a series of study series, essentially, on monetary reform and its impact on league values and positions. So the first meeting we did, the structure and function of the monetary system, all this stuff that we've all gone through, and you're kind of familiar with this. And the second one was about monetary reform, although what in fact I did in that one was really talk about the history of the competition of ideas between bank creation of money and public creation of money that has occurred throughout history, leading up to the idea of monetary reform. And then the third session, and we've done 4 of these sessions now. Third session was talk about proposals short of reform, which address some of those problems. We talked about complementary currencies. That's an old idea, which has its new wrinkle of digital currencies. Meeting number 4, we talked about public banking and modern monetary theory. And modern monetary theory, as many of you may know, has the attention of Bernie Sanders and AOC in Congress. And public banking. And for public banking session, we had Pamela Haynes come and give a presentation on that because she's involved with public banking in Philadelphia. And many of you, of course, know her through her activities with you all. And then we're going on to talk then, the remaining sessions will be about focusing on these various values of the League. And asking the question, well, how do these shape up in terms of how are they supported by these various monetary systems? So we're going to get them to fill out a sheet like this. And, you know, we're going to consider the present system, monetary reform, public banking, and all the rest, and line them up against these values of the League and have people, as a result of the discussion, do their own evaluation. Put in a plus there for one if you think that's helpful. Put in a negative if you think that's not helpful. So it'll bring people into the process of thinking about it critically. So the idea of that, of course, is to go to take it ultimately to the League at the national level. And we have people participating with us, not only Pamela, but we've got people from Oregon and California also participating in this with us. So we're hoping that we'll be able to spread it to League chapters elsewhere in the country. So let me just stop by saying the Alliance for Just Money is an enormous resource. It's got a good bibliography on its website for all this kind of material. It's a part of the international movement for monetary reform. So this is an international movement that we're involved with. And it's so timely because of this issue we face of needing a Green New Deal, but we need to stop growth. Thank you.